So you're thinking about investing in real estate, but it's hard to get started. You have to choose the right property, get a mortgage, and make a big down payment. Then you must find good tenants and maintain the property and fix broken toilets. It's a lot of work. But what if you could invest in real estate passively, spending no more than a few hours per year? And what if you could get started with just €100 instead of tens of thousands? Well, over my 18 years of investing experience, both on Wall Street and here in Europe, I've managed portfolios worth hundreds of millions. And in this video, I've put together the ultimate guide to passive investing in real estate. I will go step by step, but if you want to jump ahead, you can use the timestamps below. Okay, so traditionally, real estate investing looks like this. You buy an apartment and you rent it out. And the first question is, how much money can you make? Well, one source of profit should be the price going up. Data from the Bank of International Settlements shows that over the past 50 years in Western Europe, residential housing prices have increased roughly 5% per year on average. Now, that might sound pretty good, but keep in mind that the price of almost everything increases over time. Bread, milk, Pokemon cards. That is called inflation. And after you adjust for it, the average housing price increase has been around 1% per year. In some countries like Spain, the rise has been higher at over 2% per year, while in Germany, prices have on average simply kept up with inflation. So this means that investing in real estate could be a really good way to protect your savings from inflation. But if you want to earn a significant profit, you will need to find a tenant and start getting rental income. So how much rent can you charge? Well, this will depend on what is called rental yields for your type of property in your area. And here's how that works. Let's say you own a 2-bedroom apartment worth €200,000. And let's say that typical rental yields for similar quality apartments in your area are 5%. That means you could charge around 5% of 200,000, which equals €10,000 per year, or a little above €800 a month. According to the Global Property Guide, rental yields range from a low of around 2% per year in Macau to a high of almost 11% per year in South Africa. But most developed European countries are in the 4 to 7% range. Now, if you could actually make inflation plus 4 to 7% per year as a real estate investor, that would be quite good. And of course, if you bought the property with a bank loan, with a mortgage, you can get that kind of profit or even more. We'll discuss that in a second. But first, here's an important reality check. Being a landlord comes with a lot of expenses. To start with, you've got maintenance and renovation costs. Studies say you should budget at least 1% of the property value for maintenance per year. If your apartment costs €200,000, that is €2,000 per year. Now, people often tell me, that is way too much. I own an apartment and I'm not paying anything like that. But the problem is, maintenance costs come in chunks. You might have 10 years with very low costs, and then you have to replace the kitchen, or redo the bathroom, or change the roof. On average, 1% per year is realistic. To understand the next cost, talk to anybody who owns real estate, and you will discover that they spend many hours managing their properties, looking for tenants, communicating with tenants, and solving all kinds of problems. Every hour that you spend on your real estate portfolio is an hour that you can't spend making money or enjoying life. Then we have a third expense. Periodically, your tenants will move out, and it's going to take time to find somebody new. During that time, you will get no income. This is called vacancy loss. The fourth expense is real estate taxes. These taxes can be as low as 0% in Malta to as high as 1% of the property value per year, or even more if you are a wealthy investor in France who is subject to the wealth tax. And then finally, you have the fifth expense, which is purchase and sale costs. Between government taxes, real estate agent fees, inspection costs, and more, this can really add up. In some markets like Spain, these one-off costs can reach 10 to 15% when buying, and when you decide to sell, that also costs a lot. So if you plan to hold the property for 10 years, on average, that could cost you an extra 1% per year or even more. Okay, so when you add up all these 5 major expense categories, they can easily cost you 2 to 3% per year or more. So if we started with an estimated rental yield of 4 to 7%, these costs could reduce it to 1 to 5% per year. Assuming inflation is covered by rising prices, your real investment profit is then 1 to 5% per year. And that actually lines up quite well with academic studies. This study looked at long-term data for Paris from 1809 to 1943. And Amsterdam from 1900 to 1979. It combined both the effect of rising prices and rental income. And the result was that inflation-adjusted profits on residential real estate were 4% per year for Paris and 4.8% per year for Amsterdam. While this study, looking at the UK between 1901 and 1983, found real returns of only 2.3% per year. I did also find this more optimistic study called The Rate of Return on Everything, which looked at many countries around the world and estimated real estate yields at 7% per year. So let's land in the middle and estimate our real return as 4 to 5% per year above inflation, which is very similar to what global stocks have earned over the past century. If you can get this kind of result consistently over decades, it really grows your wealth. Okay, but you're probably yelling at the screen right now. Tom, nobody buys real estate with cash. People get a bank loan, they get a mortgage. When you invest with a mortgage, that's called leverage, and it can really improve your returns. Let's say you've got a 200,000 euro property and the price goes up by 10% to 220,000. That's an increase of 20,000 euros. And if you simply own the property outright, you've earned a 10% profit on your money. But if you had made a down payment of 20,000 euros on this same property and borrowed the rest of the money, then your investment was only 20,000, so you just earned 100% profit. That's fantastic, right? Well, there's a big problem with mortgages that many real estate investors here in Europe ignore until it's too late. But before I explain it, here's a quick note. Today's video is brought to you by me, Tom Crosshill. If you live in Europe and want to start investing, you probably have a lot of questions like which investments are reliable and which are just risky bets? What investment app or brokerage can I trust? How do I handle taxes? And more. On this YouTube channel, I answer these questions one by one. But if you'd like a faster, step-by-step investment training that takes you from A to Z and also includes one-on-one support from me, you might be interested in my program for European investors, the Index Masterclass. In this program, I teach the most reliable investment approach that I know, ETF and index investing. Today, the program has thousands of members in 34 European countries, and in my opinion, it's one of the easiest ways to get started with investing if you live in Europe. So if you'd like to find out more, just follow the link in the description. Okay, so getting a mortgage is so normalized in our society, everybody's doing it, and you don't even think about the risks, but you should. Let's go back to the same 200,000 euro property where you made a 20,000 euro down payment and borrowed 180,000 euros. If the price goes down 10%, suddenly your entire down payment is gone. The house is just worth the mortgage balance. And then if there's a major market correction and the price goes down 20 or 30%, suddenly you're tens of thousands of euros in debt. And here's the real bad news. In most European countries, mortgages are so-called recourse loans. If you stop paying, the bank is going to take the apartment, sell it, and then if it's still missing money, it's going to come after you. You're going to be in debt and possibly bankrupt. It could ruin your life. And this is not just theoretical. This has happened to many people in Europe. Now, taking a moderately sized mortgage to buy your own family residence is one thing, but taking multiple mortgages to fund your investment portfolio is much more risky, and many people have gone bust doing so. Fortunately, you can invest in leveraged real estate without running the risk of bankruptcy. The passive investments that I will explain in a minute accomplish exactly this. But before we get to that, we must explore another deep dive topic, because if you don't understand it, you're in trouble. What are the risks of real estate investing? We have already covered leverage risk, the risk of debt. Now let's look at price risk. What if you buy some real estate and the price goes down? In finance, price risk is usually measured by calculating the volatility. Roughly speaking, this is a statistical measure of how much the price jumps up and down over time. Because this is not a statistics video, I will keep the numbers to a minimum. But basically, if you look at a stock chart like this one of the S&P 500 index, which measures stock prices in America, you see that it is quite jagged. Stock prices jump up and down a lot. By contrast, if you look at a typical real estate price index like the S&P Totality Case-Shiller US National Home Price Index, the price curve looks much smoother. Prices swing around much less. At first glance, this comparison looks like a really strong argument in favor of real estate. I mean, you can get similar profits as as with stock investing, but with smoother price swings. I mean, what's not to love? But this smoothness is an illusion for two reasons. To explain the first reason, let's use an analogy with the stock market. If you buy the S&P 500, you invest in 500 big American stocks. In any given year, some of those stocks will shoot up like crazy and others will crash. But a lot of these movements will cancel each other out. So a chart of the S&P 500, which shows the market average, will not look too crazy. In fact, the S&P 500 index is approximately 1/2 as volatile as the average stock in the index. In other words, if you just hold one individual stock, the price will typically shoot up and down twice as much as the index average. Okay, so now take that same logic and apply it to real estate. In America, the Case-Shiller index tracks the price of thousands of properties. In any given year, some prices will go up while others will drop, and many of those movements will cancel each other out. The overall index will look smooth. But as a real estate investor, you're not investing in the index. You have what is called concentration risk, because all your money is in one or a few properties. And these properties will be heavily influenced by local events, like a factory closing down or a school opening. Sometimes entire cities will see declining prices for years, like Aberdeen in Scotland, where prices have dropped dramatically since 2015. Basically, the price of your single property is going to be a lot more volatile than the overall housing market. Going by the stock market example, you could expect it to be twice as volatile. But that's just part of the problem. You see, unlike stocks on the market, houses and apartments are not repriced every day. The only reliable data that you get is based on purchase and sale transactions. And the transaction happens only when both the buyer and the seller agree on the price. So let's say you put your house up for sale and you get a few offers, but they are around 20% below what you think is a fair price. Are you going to accept these offers? Or will you say, oh, these guys, they don't know what they're talking about. I'm going to wait for a better offer. This paper in the Journal of Housing Economics discusses how many homeowners will resist selling until prices rise and meet their minimum desired price. In many cases, this only happens after years of inflation pushing all prices in the economy up. So this kind of selling resistance effectively hides drops in housing prices. It makes the price risks appear much lower than they actually are. In fact, the same professors Case and Shiller, after whom the Case-Shiller index is named, published a paper back in 1989 called The Efficiency of the Market for Single-Family Homes, where they pointed out that individual housing prices have a volatility of approximately 15%, which is similar to the volatility of a diversified stock portfolio. So when it comes to price risk, the popular claim that real estate is much less risky than stocks is a myth. The price risk of holding a few real estate properties is perhaps a little lower than for a diversified stock portfolio, but not by much. All right, so far we've covered leverage risk, price risk, and concentration risk. I'm also going to briefly address a few more critical risks that real estate investors need to keep in mind. There's liquidity risk. Real estate can take months or even years to sell. Tenant risk. Some tenants will refuse to leave or even damage your property. Macroeconomic risk. When a recession hits, your tenants might lose their job and stop paying. Regulatory risk. Property taxes can go up and there can be new legal restrictions, like in Barcelona, which has decided to ban short-term tourism rentals by 2028. Interest rate risk. When rates go up, your mortgage goes up and property prices can go down because buying gets harder. Physical risk. Fire or floods can damage your property. Liability risk. Somebody could get hurt on your property and sue you for damages. And finally, there's co-owner risk. This overlooked risk applies when you own a condo or apartment in a building. For example, I live in Riga, Latvia, and a lot of the housing stock here is old Soviet apartment buildings. If you buy an apartment in one of these buildings, you can get a really high rental yield because the apartments are cheap and many middle-class people want them. But the problem is, these houses were not built to last for centuries. Many of them are becoming dangerous to inhabit unless expensive renovations are done. And because many of the apartments belong to low-income families or retirees, they will often refuse to pay for such renovations. So your asset could actually go to zero simply because the co-owners of your building will not cooperate. As you can see, real estate investing is no bed of roses. Yes, long-term profits tend to be good, and you can amplify them by getting a mortgage. But managing real estate is a lot of work. There are plenty of expenses, and you're taking a lot of risk. Well, what if there was a passive way of investing in real estate which fixes these problems, which removes many of these risks and headaches? Well, it really does exist. The solution is called REITs and Real Estate ETFs. I'm going to start with REITs. REIT stands for Real Estate Investment Trust. They were invented in America in the 1960s, but today many other countries had their own versions as well. Now, there are different types of REITs, but I will focus on public REITs. These are companies that you can buy on the stock exchange like any other stock. The first big benefit you get as a REIT investor is diversification, because a typical REIT owns hundreds or even thousands of different real estate properties. For example, apartment complexes, office buildings, or warehouses. The second benefit is that you don't have to do any of the work. A REIT has a professional management team and employees which maintain the properties, rent them out on a massive scale, and generate a lot of rental income. The third benefit is tax efficiency. Before REITs were created, investing in real estate through a company was less attractive because you got taxed twice. First, the company paid corporate income tax on its rental income, and then you would pay personal income tax on your dividends. But if a company has REIT status, it doesn't have to pay corporate income tax. So that leaves only one layer of taxes, your personal income tax. Now, of course, governments don't make this kind of massive tax break available to most companies. To qualify for REIT status, the company must typically meet three criteria. 1, invest most of its assets in real estate. 2, earn most of its revenues from rent. And 3, pay out 90% of its taxable income to investors as a dividend. Although, of course, the exact rules can vary depending on the country. Basically, REITs are kind of like an investment fund which holds and manages a lot of rental properties, covers the costs, and pays you most of the income that is left over. For this reason, REITs are popular with dividend investors. They love that REITs are forced to pay out dividends as long as they are profitable. Now, of course, if the company starts losing money, the dividends will stop, but in good times, they pay out quite reliably. For example, the American REITs included in the FTSE Nareit All REITs Index pay approximately 4.3% per year in dividends on average, compared to 1.1% per year for the S&P 500. Now, as we've discussed on this channel, high dividends aren't always better for investors. In fact, they can create a tax problem if you're not careful. But many investors do want dividends, so that's the fourth REIT benefit, high dividends. And the fifth benefit is leverage. REITs borrow money to finance their real estate investments, and that typically boosts your returns. Now, of course, it also increases risk, and REIT stock prices can collapse when leverage goes wrong. But if things go really bad, only the company is on the hook, not you. Unlike when you buy a house with a mortgage, you can never lose more than your original investment. Okay, but now let's look at a real example of a REIT. And to be clear, this is not an investment recommendation, only an example. One of the largest REITs in the world is Prologis Inc. Prologis owns and rents out huge amounts of commercial real estate, most prominently warehouses near large urban centers. Its tenants include Amazon, Home Depot, FedEx, UPS, Walmart, and other major corporations. The company's portfolio has around 6,000 different buildings all over the world, although the majority are in America. Like any REIT, Prologis uses debt to fund its investments. As of December 2025, Prologis had debt of $35 billion against net real estate investments of around $92 billion on its balance sheet. But how profitable has this stock been for investors? Well, when you buy shares in a REIT, you earn a profit either because the stock price goes up or because the REIT pays a dividend. And because REITs are supposed to pay out 90% of taxable income as dividends, you might imagine that most of your profit will come from the dividends. Now, REITs do pay a good amount of dividends, but actually not as much as you might think, because that 90% rule is calculated on the basis of taxable income, not rental income. And to get taxable income, you have to subtract all the expenses of running the company and maintaining the properties, plus an accounting item called depreciation and amortization, which is usually very high for REITs. For example, Prologis in 2025 had rental income of $8.2 billion, but its taxable income was only $3.8 billion. Now, Prologis investors have been receiving substantial dividends. Payouts have ranged between 2% per year to 3.5% per year over the past decade. But a lot of investor profits came from a second source, the stock price of the REIT going up. REIT shares can go up in value for many different reasons, such as increasing rents, higher occupancy rates, rising prices, new property development, and more. And in fact, Prologis stock price is up 3.7 times since February 2016. That's an annualized increase of 14%. So for Prologis investors, rising stock prices have actually been a much bigger profit driver than dividends in recent times. That said, looking at a chart of the Prologis stock price also highlights one key disadvantage of REITs compared to direct real estate investments. As you can see, the price has bounced all over the place over the past 10 years. Basically, REITs have a similar level of price risk to other stocks. They bounce up and down and change every day. And that means that the value of your investment gets updated in your brokerage account all the time. If you check your account often, which by the way is a bad habit, this can be a lot more stressful than holding a house or apartment, which only gets revalued when you try to sell. So the first major disadvantage for REITs is that they trade like stocks. A second disadvantage of REITs compared to owning properties directly is that you lose control. You are fully exposed to management decisions. If the company's management does a bad job, or if they are dishonest, or if they are too aggressive and make some risky bets like borrowing too much money, then your investment will suffer. A third disadvantage is that, like any structure that is similar to an investment fund, REITs can be quite expensive. In some cases, there are explicit management fees paid to external managers. In other cases, you are simply paying the salaries and bonuses of internal management as well as other administrative expenses. And all of this can really add up. Then a fourth disadvantage is that a single REIT is typically focused on a particular type of property, like residential or office or logistics. And if that property type runs into trouble, the REIT runs into trouble as well. For example, COVID was particularly painful for office REITs as many companies transitioned to a work-from-home model. And a fifth disadvantage is that REITs can have mispricing issues. The share price of a REIT may either over or undervalue the actual real estate properties held by the REIT because investors get too enthusiastic or they lose hope in the company because of inaccurate property value estimates and bad reporting or market liquidity problems. Okay, so looking at all these benefits and drawbacks, have REITs actually been a good investment historically? Well, the past decade has been a relatively poor period. REITs have had weak results since interest rates went up in 2022, which meant increasing borrowing costs for real estate investors. Looking at the American market, the average REIT return has been around 5% per year compared to 14% per year for the overall stock market. But if you look at the previous 2 decades, between 1996 and 2016, REITs actually outperformed the stock market at more than 10% per year versus 8% per year. In general, if you look at long-term data, REITs and stocks have had very similar results. And that should make intuitive sense, because REITs are a mixture of stock and real estate investing. And we already discussed earlier that long-term real estate returns and stock returns have been quite similar. But of course, this leads to a natural question. If REITs have performed about the same as stocks, why bother with REITs at all instead of just investing everything in stocks? Well, the answer is diversification. Unlike most other types of stocks where the results depend primarily on business performance, REITs have a strong exposure to the real estate market. And this means that REITs only have a moderate correlation with other stocks. Basically, REITs and other stocks often go up and down at different times. Now, the correlation is not low, it is moderate. So part of the time, for example, in a major stock market crash, REITs tend to move together with other types of stocks. But adding a REIT component to your stock portfolio can reduce the risk somewhat without lowering your expected return. So how much of your portfolio should be invested in REITs? I'll explain that in a minute, because first I must address something else. How do you choose the best REITs to buy? Should you become a REIT expert who builds Excel models, studies financial statements, and follows industry news? Well, I wouldn't recommend that to most people. When I said that over the long term, REITs have performed similarly to stocks, I assumed that you invested in the REIT market as a whole. So that's hundreds of different REITs covering different geographical regions and different property types. If you buy individual REITs, you likely would have gotten much worse results. That's because picking individual REITs is a form of stock picking. And stock picking is very, very difficult. Most individual stocks do poorly, and most of the wealth created in the stock market comes just from a handful of top stocks. This paper by G.C. Huang suggests that the same logic holds true for REITs. Out of 371 REITs studied between 1972 and 2020, 60% of total net wealth creation came from just the top 20 stocks. And because the profits were concentrated in just a few winners, most individual REITs underperformed the market. Unfortunately, predicting which REITs will do great ahead of time is very difficult, even for professionals, and that makes picking individual REITs very risky. So, what's a better alternative? Well, when investing in the broader stock market, it's usually a best practice to diversify among hundreds of different stocks. And the easiest way to do that is to buy an ETF or index fund, which buys a little bit of every stock in the market and gives you the market average result. As Warren Buffett likes to point out, ETFs and index funds typically get better results than most professional investors. So why not use ETFs to invest in the REIT market as a whole and get the market average result? Well, you can, but there are some nuances. For American investors, this is easy. There are ETFs like the Schwab US REIT ETF, which invests in 122 different American REITs. But here in Europe, we can't buy US-based ETFs directly because of European regulations. And if you go to justetf.com, the biggest database of ETFs available to European investors, and if you search for REIT, it's going to be hard to find any ETF that is 100% invested in REITs. Instead, you will find a lot of ETFs that invest in all kinds of real estate companies, not all of which are REITs. You'll get a mix of REITs and non-REITs in different proportions. And that's not necessarily a bad thing, you just have to be aware of the difference. On the one hand, non-REITs pay corporate income tax, so they are less tax efficient. But on the other hand, they have fewer restrictions, so these companies can make more money from things like developing new properties as opposed to just having to focus on rental income. And then on the third hand, non-REIT business models can be more risky compared to a company that mostly holds rental properties. In my view, both REITs and non-REITs can be interesting for passive real estate investing, but if you prefer one or the other, you will have to check ETF by ETF to see what each fund contains. So now let's go to the Just ETF database and type in REIT in the search bar and see what we can find. Let's look at a few of the biggest ETFs on this list for European investors. And of course, these are not investment recommendations, just illustrations. So first up, we've got the HSBC FTSE EPRA NAREIT Developed UCITS ETF USD. And that name really is a handful. But at the end of the day, this is simply a fund that invests in 357 different real estate companies that are based in developed countries. So because this is a developed country ETF, if you look at the holdings section, you'll see that around 60% of this ETF is invested in America. And if you go to the HSBC website and look up this fund, you will see that around 85% of the fund is invested in REITs. Okay, so if you're looking for a REIT ETF, this is about as close as you can get here in Europe. Next up, we've got the iShares European Property Yield UCITS ETF. When an ETF has yield in the name, that usually means it focuses on stocks that pay dividends. And when we open up this ETF, we see that it's substantially less diversified. It's only got 60 stocks. And if you analyze the holdings, you will see that most of them are not REITs. So most of these are non-REIT real estate companies. Then further down the list, you have the iShares Developed Markets Property Yield UCITS ETF. This is actually very similar to this first HSBC fund, except that it screens out some of these companies which maybe don't have such a high dividend yield. So it has slightly fewer holdings than the HSBC fund. And then the last ETF I'm going to look at is this Xtrackers FTSE EPRA NAREIT Developed Europe Real Estate ETF. So again, this is a European real estate company ETF. It's a little more diversified than the property yield one. It's got 104 holdings, and around half of the holdings are REITs. This fund is different because it also includes the UK, while the previous fund we looked at excludes the UK. It looks at continental Europe. With real estate ETFs like this, you can invest in a diverse portfolio of real estate completely passively, without having to find properties or manage tenants or take out a mortgage to finance your investment. I think there's a reasonable argument to be made that maybe a 5 to 10 or 15% real estate ETF allocation could be a sensible way to diversify your portfolio. If I wanted to add a real estate exposure to my strategy, that is what I would do. All right, but if you are new to this, buying real estate ETFs or any other kind of ETF can can be confusing. You get questions like, which ETFs do I choose out of the many available? Do I pick accumulating or distributing ETFs? And by the way, this is particularly important for real estate ETFs, which pay a lot of dividends. What brokerage or investment app is best for buying these ETFs? And after I buy them, how do I handle my taxes? If you'd like a step-by-step guide to ETF investing, where all the training that you need is in one place, and where you can ask me all your questions, then you might be interested in my training program for European investors, the Index Masterclass. It's got over 8,000 members in 34 European countries, and honestly, I think it's pretty wonderful. So if that sounds interesting, watch this video next to find out more.